Okay, hi everybody. My name is Caitlin Wally-Stoll, and let me just get this. And I'm the Farm Business Management Specialist with Cornell Cooperative Extension, Southwest New York Dairy, Livestock, and Field Crops program. I am going to help us get started here, and then I'll turn it over to our amazing presenters tonight, Elizabeth Higgins and Bonnie Collins. I can't talk tonight. And both of them will introduce themselves later on. So to kick it off, if you've attended any of these other workshops, just pre-apologies because they are pretty much the same slides. So, so this is the last course as our 4-part series finishes out, all about taxes for farms. We really appreciate the incredible response that we've gotten as far as registrations and participation and all the really good questions that everybody has been bringing. We always really appreciate good, insightful questions. And the other thing we appreciate too is everybody's very open feedback that's let us kind of adjust how we were presenting things. And all of us are already thinking about other workshop topics to come. So tonight's topic is farm-specific tax code benefits. We'll run from 7 to 9. And like I said, Bonnie Collins and Liz Higgins are your presenters, and they will introduce themselves later on. Just a couple of housekeeping things. If you have any questions throughout the presentation, the best thing to do with the number of people that we have attending tonight is to type them in the chat, and then we'll pause throughout to take questions. Once we get towards the end, if you have a question that you want to unmute and ask, we definitely welcome that as well. You can send a private message in the chat by selecting myself or any of our other hosts, and we'll be the only ones to see it if you have a question that pertains specifically to your farm. We are going to mute everybody and turn off everyone's video just in the interest of bandwidth. And everybody should have received an email tonight. Following tonight's email, you'll also receive a follow-up email that'll have resources and slides from this evening, as well as the session recording. And at the end of this evening, we're going to give all of you guys a post-course survey where we're going to ask for your helpful feedback, ideas for future topics, things that you really liked, things that you would like to change. And we appreciate any and all thoughts that you are willing to share. And everybody, again, will get the recording in a follow-up email as well. And for anybody that missed out on our prior 3 courses, which were income tax planning for farms that file as Schedule F, farm financial records for decision making and tax management for beginning and small farms, and you're interested in getting those recordings, those slides, and those resources, please just send me an email and I will help you get that set up. And one last shameless plug that I have for tonight. We have a really excellent program coming up that most of us on the farm business management team that have been involved with tax school are working on. It's called Small Farm Financials, and it's done with a peer learning circle. So these are small discussion-based, peer-based learning where you get a chance to go over your farm's financials and evaluate the state of your farm business and kind of make goals to narrow down what you're looking for financial outcomes. The program's free, but you do have to apply. We do have a limited amount of spots available, and everybody that is successful with their application will receive a free tablet to help improve their record keeping abilities and participate in the program. So I've included the link here, and I'll also include that in the follow-up email. If you have any questions, please don't hesitate to ask. And then as a disclaimer, this information that we're presenting here tonight is for educational and reference purposes only. We definitely recommend that everybody has a financial preparer, certified accountant that they're working with to help their farm businesses. So this information that we're presenting is based on our best knowledge, and it might not all be applicable to your farm. And we want to thank our amazing sponsors, which helped us to offer scholarships to participants who needed those. 2020 Consulting, MBT Bank, Farm Credit East, and New York FarmNet. And then finally, just as kind of like a grounding thought to keep in the back of your mind as we're going through this, throughout the presentation, what we would like for you to do is think about the pieces of information that you can best utilize for your farm business. So we're going to throw a lot at you. Not all of it's going to apply, and I don't want anybody to feel like you have to remember all of it either. So we're giving you the slides, we're giving you the recording. Just take a deep breath, pick out the pieces that apply most to your farm, and we hope that you find some of this very helpful for your farm business. Okay, and with that, I'm going to turn it back over to Liz and Bonnie.
Great, I think Bonnie is going to start.
Let me unmute myself. I'm sorry, my internet is really unstable here, so I'm sorry, and I won't ruin your evening by having to look at my face this morning, so or this evening, anyways. So sorry about that. So let me know what you are seeing.
Perfect.
You got it?
Yep.
Okay. So thank you, folks. My name is Bonnie Collins. I still for a while am the farm business manager at Cornell Cooperative Extension in Oneida County, which is central New York. I'm also the program team leader now and have been for a while, and I just moved over to program director. So now I'm responsible for all the programs going on in the ag department. So excited and just trying to learn my way through all that. So not involved, but I really love the teaching part, and I get a few more months to at least participate in the teaching part of it. So I really appreciate it. So Liz and I go back quite a ways in supporting each other in what we do. Liz is a great colleague, learned a lot from her, and I'm sure you will tonight, this evening. I also have been with Cornell for 18 years, but I started a small accounting business back in 1984. So I think we're going on 37 years. Please do not do the math and guess my age, okay? And I love it. I love educating the adults. I think they're great. And we're not trying to make you accountants. That's not what we're trying to do. We're trying to provide information to you so that you can ask maybe really good questions, and don't be afraid to ask that. Oops, sorry about that. Didn't know how this one was going to work. So I'm at my home computer. So tonight I'm going to cover the income tax farmers, not all of them specifically for farmers, but for any business. So it's going to affect you as a farmer. I'm going to look at a few tax planning strategies and then hopefully ask some questions. You will ask some questions, put them in the chat, and then we'll get to them. And then Liz is going to be covering the tax incentives that we have for farmers. Okay. So let's talk about this. Effective tax planning may result in the postponement and the avoidance of income taxes. The objective of this presentation is to reduce taxes by taking advantage of beneficial tax law provisions, increasing or accelerating tax deductions or credits, and making use of all the tax laws in a manner most beneficial to your farm. So that's what our goal is here. We hope to do and look at that. So income tax benefit for farmers. I'm going to talk about, and I know sometimes when we talk about tax or tax law or rules, it gets a little dry, but I think the reason it's dry is because a lot of times I use the IRS codes and try to give, precise information as I can about something. If we can't answer your question, hopefully you'll type some of that information in the chat box and maybe we can answer that individually. Again, thank you for being here. So I'm going to run through a few things, depreciation deductions, which we could probably spend a whole 2 hours on in depreciation and what you do with that. We're going to look at crop insurance and how that may affect your return. Farm income averaging is another one, net operating losses, loan repayments, and then of course the fuel and road use tax for farmers. Okay, so depreciation deductions. So when we look at depreciation deductions, again, these are assets, capital expenditures, normally that have a useful life for more than 1 year. The tax code has specific classes as a life for a tractor, let's say for furniture and fixtures. The IRS tells you what the life is for that asset and has specific the amount of depreciation you are entitled to each year. Now, there's different ways to do that, but we're not going to get that deep into it. The nice thing about the depreciation deduction and how we can use that is if you make a current year capital purchase, you have the choice to use the option of something called a 179, meaning you can deduct the full amount of the asset value, okay, new or used, up to the gross business income for that year. Okay, and there's something also called bonus depreciation where that restriction is not allowed. Again, we're not asking you to learn what is it, but just be aware that there are different ways to take depreciation. And I'll give you an example. So if I'm working with a farm and say they bought, a $125,000 piece of equipment in the current year. So, they have revenue that may cover that. Do I want to write off? This is a management tool you think about. Do I want to write off the full value of that? Some farmers would say yes, because that's money out of my pocket. I wanted to take the deduction this year. But what happens if you take it in 1 full year? You now have no depreciable write-off for the next year's coming up, and then you may be paying a higher tax on that. So it's something to use. Depreciation really should be used as a tax planning tool as you go forward. So as I say, the IRS giveth, but the IRS also takes away. So if you fully depreciate something, then you sell that asset. What do you think you're going to have? Capital gains is going to be, so the government, you took that deduction, and then if you make a capital gain on that, the government wants their piece of the pie on that asset as a capital gains. There's an IRS publication, 946. I'm going to share my document that I'm using this evening. We'll make that a resource for you as I talk about each one of these sections because I have specific things written down. Crop insurance. So you must include in income any crop insurance proceeds you receive as a result of crop damage. You generally include them in the year you receive them. Treat as crop insurance proceeds the crop disaster payment you receive from the federal government as a result of the destruction of damages to crops, or the inability to plant crops because of drought, flood, or any other natural disaster. I'm not sure how many people are involved with crop insurance. If we're talking to vegetable growers, not too much is used in there. Some of my big farmers, soybeans, corn, they are using this resource. The other option here is you may have a choice, again, following all the rules, to choose to postpone that reporting until the following year. And that is right on a Schedule F to do that. So crop insurance will give you some links to learn about that. If you're not familiar with it, your FSA office is the place you can go to learn a little bit more about it, who is eligible for it, and at what element you want to perhaps purchase crop insurance. Farm income averaging. You may be able to average some or all of the current farm's income by spreading year and eligible to do. The one thing is that corporations, if you're incorporated, partnership, and an S corporation, a state and trust cannot use this farm income averaging. So if you're a sole proprietor, this is something that is available to you. Net operating losses. You can turn your net operating losses into a tax break, is the IRS lets you deduct the loss from your income on another year's tax return. With the net operating loss carry forward, you save your net operating loss deduction for your future earnings. When a net operating loss carryback, you can claim it against taxes paid in earlier years, giving you a retroactive refund. The carry forward and carry back rules changed significantly in the past 4 years with the passing of the Tax Act and Job Act and the CARES Act. And with the new administration, more changes are possible. If you plan on taking a net operating loss deduction, check with your tax preparer so those rules change. Every time we change, someone sitting in the White House or a Congress, the rules, the IRS rules can change in a heartbeat. Some things expired, some things get to continue on in the next years. As you can see that happening in the last couple of years with obviously the COVID and the stimulus packages. We're just getting into tax preparing and, you know, the third stimulus package. I'm just curious how many people on this call got the third one. Most of my clients did not. So you can claim that on your tax return. Okay, so loan repayments. You can only deduct the interest you pay on a loan. If the loan is used for your farming business, you can't deduct interest if you paid on a personal loan. So again, this is a benefit, right? If I'm borrowing money, yes, your home mortgage, we used to be able to deduct the interest for our home mortgage, but they raised the standard deduction so high that it's pretty tough to get itemized deductions now. And I don't want to get into, I can answer, you know, personal questions as we get into it. But again, the benefit for the loan repayments is that interest write-off for your business. And then the fuel and road use tax. So owners, operators, and tenants of farms and certain other persons may be eligible to claim a credit or refund for excise tax or fuel use in the trade or business of farming when used on a farm in the United States for farming purposes. There is a form 4136 that is a fuel and use tax, and then a credit you can get on your tax return. And Liz is going to talk about some of the other great tax incentives.
Hey, Bob, I'm not sure if you can hear me, but you're cutting in and out. Bonnie, are you still there?
I know it's very, yeah, I'm here. I don't know what the problem is.
That's okay. Why don't, if you can, do you want to start from the beginning of fuel and road use?
Okay, is that when I cut out?
Yep. And then we're going to circle back to another part first, but while you're on this slide.
Okay, so what I said about fuel and road use, owners, operators, and tenants of farms and certain other persons may be eligible to claim a credit or refund of excise tax on fuel used in the trade or business of farming, right? So if I go down to the gas station, load up, there's an excise tax on there, and that money can be deducted on Form 4136 to take away that tax that you paid. You can reap it back on your tax return. Okay, did you want me to go back to another slide?
If you could circle back to farm income averaging.
Yep.
We missed out on the part where you were saying what business structure could use it,
Yeah.
ones couldn't.
Okay, I'm sorry, guys. And again, I'll get the document to you that I'm reading off because I figured that was the best way. And things like this happen. I already sent it to Kate, so she has it. If I completely wipe out here this section anyways. So the farm income averaging, you may be able to average some or all of the current year's farm income by spreading it out over the past 3 years. This may cut your taxes if your farm income is high in the current year, but was low in the prior 3 years. Corporations, partnerships, S-corps, estates, and trusts cannot use farm incoming averages. So if you are a business structure, such as a corporation or a partnership, this is not available to you. Any other ones that you missed?
Michael Robertson is asking about LLCs and how that would apply to them.
Okay, so remember LLCs, which is a limited liability company. It's not a corporation, it's a company. And the IRS tax LLCs as partnerships. So technically this is not available to an LLC also.
Although, can't you have an LLC, Bonnie, that's essentially a sole proprietor? In which case it would be, because LLCs aren't really like recognized as taxable entities. Because you can have a single operator LLC.
So if there's more than one member and it's taxed as a partnership and you have to make that determination when you're doing LLC. I see the internet is unstable again.
Yeah,
Oh,
so
sorry about
if you're a single owner LLC, then you could do it because you'd be filing as a sole proprietor, you'd be filing as an individual return on a Schedule F. But if you're a partnership or a corporation, you can't.
Correct. Thanks, Liz.
Sure.
So the other thing I wanted to bring up, and it's kind of off the cuff, but if anyone was given or participated in receiving the PPP loans, those proceeds for forgiven PP loans are exempt from federal income taxes, but you can also deduct the expenses that were paid off with those proceeds of the loan. The IRS stated in rulings last year that such a double dip wasn't allowed, but Congress overruled that in December of 2020. Liz, are you going to talk about any of that?
I was not going to go into that in much
Okay.
detail now. So that's
fine. But I want those are things that I know people in businesses that I work with, and some of the farms got it. So just to be aware. And again,
they
this
changed
is about
the rules. Yeah, that was something they changed the rules on. So it was definitely confusing.
Yeah. So again, tax planning. I talked about the strategies for tax plan question.
Yep, we've got one more question.
Sure.
Would income averaging work for general partnerships versus registered partnerships?
I'm not heavy into partnerships. Liz, do you know the answer to that one?
I don't. The only thing I can say is that, sometimes there are business structures that are not necessarily, they don't flow through to the federal tax. So, this is not my area of expertise, but I don't know whether, yeah.
Yeah, so here it is again. We're making you ask the question. So if the only thing you got tonight was to ask that question, then guess what? These educators did their job as far as I'm concerned. And if it's a tool you can use.
And I think one of the defining places there would be if they're filing a 1065 for the partnership, then it's a partnership.
Mhm.
Correct.
So it wouldn't matter whether it's registered or not if they're following the 1065.
Yeah, I think that's the key thing is how you're like, what forms you're using to file your taxes at the federal level will determine what you're eligible for.
Exactly. Okay, so a few tax planning strategies. I mentioned the section 170 deduction for depreciation and the bonus depreciation. Again, the rules change quickly, but again, these are things that you should be asking about, especially in the year that you're making capital purchases and when depreciation is going to be really making that decision in that current year and how you want to use that for planning forward. Sometimes we can defer sales. We talked about income averaging a little bit, and then the prepaid expenses. You always hear, I work with dairy farms and they're saying, oh, we got a little cash in our pocket. We don't want to, we're going to buy some feed for next year. So we're going to prepay that, put it in our books, and then we're taking the write-off in as a tax deduction. So tax planning, looking at some of the things, what is taxable. We could look at our money market accounts, our certificates of deposits. What can I defer in taxes, and what tax advantages can I take with, what can I use my money for after tax money is what I'm talking about. And what can I do, because I don't think producers have a really good habit of saving money for themselves and looking for the future, but we know it's going to come. So that part of your tax planning strategy should be for you and your family going forward at that point. So you can't tax plan if you don't know where you are today. I'd ask you to aim to start planning for your taxes as soon as the tax year begins, instead of scrambling at year end. It's too late. How many times do we get people in November and December, they're looking at the records and saying, okay, I got a cash pile. What am I going to do with it? That's not the way we should be really addressing this as a serious business owner. You want to assess your financial health, evaluate your accounting processes, and also consult a tax preparer to help you reach the goals you have for your coming year. What do you want to do? We've been teaching a lot this week, and it seems like this month about balance sheets and what's on our balance sheets and which way our equity is going, and looking at using that as a tax management planning tool. So I hope that was quick. I'm a fast talker. I'm into questions. When we get to it, we'll let Liz take her piece, and then we'll go from there. Unless there's any questions I can ask specifically for this. We got great colleagues on here, guys. So please ask your questions.
While Liz is getting her slides up and going, if you guys have any questions about the topics that Bonnie introduced, please feel free to type those in the chat and we will get them covered for you. All right, so it looks like everybody's good for right now. I did type this in the chat, but we turned on the closed captioning. And if you find that that's distracting at the bottom of your screen, there is an option to turn it off. So you'll see a little button that says CC live transcript, and you can click on that and have it turned off for your screen specifically. So now we're going to turn it over to Liz Higgins.
Great. So I'm Liz Higgins. I'm a ag business specialist and production economist with the Eastern New York team. I focus on fruit and vegetable production. Like Bonnie, I've been with Extension for many years. I have a background before I came to Extension working in federal and state policy, ag policy also. So a lot of my focus tends to be on looking at programs specifically that are targeted to farmers. So that's kind of my value add to this. And so Bonnie really did, I think, a great job capturing sort of some of how, you know, the tax code is really written in many ways, you know, to benefit ag. And, you know, if you really can dig into it, I mean, we only have limited time tonight, but there's a myriad of ways that one can, you know, sort of set their business up and you know, use the tax code as a way of, you know, sort of helping their business. And, you know, I get questions all the time from people who want grants for farms. And I think a lot of people who come into agriculture from other fields and from other areas, they think that most assistance from the government is in the form of grants. And for a nonprofit or for a school or something, that may be the case. But actually for businesses, you know, most benefits are actually, you know, financial benefits are really written into the tax code. And why is this? You know, a lot of this is tax incentives. They allow easy means testing and targeting of benefits, you know, so you know, if the program you want it to be geared towards people who have incomes between this level and this level, you know, if you have them do it, you know, through their tax return, you pretty much know what their income is. You know, so you can also, a lot of times the credits, you know, especially for business, are based on activities like putting in infrastructure or buying land or hiring employees that'll be reported on your taxes anyway. So being able to give somebody a credit based on what they have to report on their taxes or might report on their taxes, you know, kind of kills two birds with one stone from a reporting and record keeping. You know, you could also, you know, if you're like more cynical, you could say, well, penalties for dishonesty. You know, you can have a program. Let's just say I have a program and I want to give money to businesses. Then I have to like figure out how I'm going to enforce it. If I put it into the tax code and somebody lies on their taxes, you know, penalties for dishonesty are already built into the tax code, you know, or into the tax program. So it's sort of, that also is another way of providing some sticks and some oversight and some ability to really look at, you know, what people are doing. And then finally, there's already existing infrastructure within these sort of systems for record keeping and monitoring. You know, people have to save their tax returns for a certain number of years. There is already sort of a compliance arm in most tax systems and stuff. So, you know, so even though there are grants for farms, the reality is this: if you're looking for funding assistance in agriculture and you're looking for, you know, money that's there to support your farm business, you really should be looking at tax credits, tax incentives, tax advantaged ways of structuring your business, because that's where the more consistent funding is. And that's where you can be pretty confident about how and know in advance, as opposed to applying for a grant and not knowing if you'll get funded or not. With the tax code, you will know whether or not you're eligible, and if you are eligible, you will know that you will get those funds, you know, so it makes sort of planning and sort of assessing what will happen a lot easier. But there are things to consider when you're thinking about tax credits, is that if you're eligible for one program, you know, based on being a commercial farm or having employees, that doesn't mean you're eligible for a different program. So even within the tax code, different programs have different eligibility criteria. So for example, in New York State, and I'll talk about this, you know, they have a sales tax exemption for commercial farms, but the only definition of a commercial farm really is somebody who is selling something, an ag product in production commercially. Like you don't have to do, you know, there's no like acreage test or income test or anything like that. Whereas other programs, you know, like the farmer school tax credit, you have to have a certain percentage of your income from farming in order to be eligible. So what might count as a farm for a program in one program will not count as a farm or an eligible commercial farm in another program. So it does make it more complicated. Programs change all the time. You know, Bonnie mentioned the PPP program, the Paycheck Protection Program. When that first came out, the IRS said, you know, if you get this loan, the federal government, you know, you can't deduct the expenses that this grant paid for, And that's pretty typical with a lot of grant, with a lot of tax, advantaged or grant funded programs. But then they changed the rules after the fact and said, no, you can in fact deduct expenses that you used PPP funds for. So a program can change. And in some cases, a program, they can change the rules such that, it might be to your advantage in some years to go back and refile your taxes for a past year because you realized that you missed something or they changed the rules and you didn't realize it. So having a tax advisor who's familiar with agriculture can make a big difference. But in some cases, especially with tax credits, they might not be aware of all tax programs, especially if they're not handled through an income tax return. So another piece of advice I have is definitely join a commodity group or an industry group or ag group like Farm Bureau, because these groups keep track of legislation and especially things, that benefit their members like tax incentives. And so by being on their mailing lists and stuff, this will help you be aware of what's going on and when a program comes around that might be suitable for you. Because, I've been doing this for 30 years and I still miss stuff, and I'm paying attention and I know where things are. So I can only imagine, somebody who doesn't have the experience I do and who's trying to run a business and probably has a family and, maybe has a hobby, and has a life, trying to keep track of all this stuff is really hard. So let professionals do it and help you. And one way to do that is by, taking advantage of, organizations that have paid people who focus on this all the time. Read a lot, get newsletters, read them, and keep abreast, if you're really a serious business, that's part of your job. Get on the mailing list for your local economic development office. If there's a state program or a county program or something, if they know that you're looking for things and they're aware of you, they may let you know. So these are ways, that you can try to sort of keep abreast of stuff. So there are 3 common tax incentive modes. The first one would be reductions in sales or property taxes. And these are, things that, you would get it, you don't pay sales tax or you get a reduction on your property tax. So these are outside of the income tax process. The next kind of tax incentive mode, like where you would actually get the money, and these are like how you get the money or don't pay the money, is your state income tax return. You apply for it and you get the money, by applying on your state income tax return. And then the last is your federal income tax return. So these are, there are exceptions to this, but in general, these are sort of the big 3 is like, where do you actually get the money on these income, these tax credits? So sales and property tax, and these are programs that either reduce or eliminate taxes paid by commercial farms. I am gonna just go through these programs pretty fast and maybe give like a sentence or 2 on each one. You're gonna get a handout that has links to every single one of these programs that has much more detail. And at the end, I'll leave time for questions if you have questions about a specific program. But there are some programs here that I could spend an entire workshop on. And then there are other programs that are very simple. So this is going to be just to give you a big overview. So the first big one that I hope you're aware of is the sales tax exemption for commercial ag production. That is one where you basically bring this form ST-125 to the store and, and then you have it all filled in and then you don't pay sales. Then they don't charge you sales tax on what you're buying. And that can save you, I see people all worried about getting a grant that might be $100 or something. But if you are buying major stuff for your farm for production, and this tax credit includes equipment, it includes building supplies, it includes all of the resources that go into pretty much ag production, this can be a lot of money. So this is a fairly significant benefit to farms in New York, and certainly something that, you should fully take advantage of. Always use this. This is probably one of the strongest benefits you have as a farmer in New York. And it's super easy. And if for some reason, you know, and when you go to the link, if for some reason you forget to do it, there is a process in New York where you can take your receipts and you can file to get a refund of sales taxes that you've paid. It's more of a pain in the butt to have to do that, but you can do that. I think it can go back a couple of years. So if you haven't been doing this or you missed something, you know, I've known some people who've made a major purchase, didn't realize, especially newer farmers, didn't realize this was an option. It's not too late. You can go back and get a refund. Also, in some cases, you know, a vendor, the store has the right to deny you, to like not give you the sales tax exemption because they're not confident that you're a commercial, like what you're buying is eligible, or that you're a farmer. If that happens, you can once again apply to the state and get the sales tax refunded. So you, even if you don't get it through the store, you can get it directly from the state. Very similarly, New York State has a tax exemption and refund for fuel or gasoline used in agriculture. You can either use Form FT 1004 to be exempt, so you don't pay the tax up front, or you can use FT 500 or FT 420 to get a refund on the sales tax that you've paid. The use that this fuel is for is very specific. So it's not every bit of gasoline or fuel that you buy. It's for very specific uses. But once again, this can be a very significant savings for your farm. All of the items in brown are sales tax benefits, and there will be tax benefits that are not only specific to ag, but I think that they're applicable for many farms or farm businesses, at least that I deal with. And in some cases, you may not be aware of them. New York, it's interesting, when I went through their list, like there's a ton of stuff that's exempt from sales tax. Like, for example, I didn't realize that college textbooks purchased by college students for a class, required texts, are actually exempt from sales tax in New York. And I've done this for years, and I have a college student. I'm like, shoot, so, it's worth looking at the list, and I have a link to the full list in the document you'll get. But like, there's an exemption on sales tax for items for resale. So if you've got, let's just say you've got a farm store and you buy stuff to resell, you can be exempt from sales tax on what you buy for something that you're going to resell. And they just recently changed the law that can also include food that you buy that you're going to resell. So if you are buying food, prepared foods that would otherwise be covered by sales tax, let's just say pies from a bakery or sandwiches, and you're going to resell them, you can be exempt for sales tax on that because you're going to charge sales tax to the customer. So that's a big one. Promotional materials is another one that so brochures about your farm, let's just say you've got to pick your own that you're having made, or you're going to make some signage and stuff like that. There is, you have to look at the rules, but there's an exemption on the sales tax that you pay for items that you're going to use for promotional materials in your business. And if you are not selling them directly to the customer, no, if you're not going to sell them to a customer, then you have to pay sales tax on it. The only thing that you don't pay sales tax on is something that you are buying from somebody that you will resell. Anything that's left in inventory or that's not sold, you actually do owe sales tax on. So it's only stuff that actually will definitely be sold or that you do sell. And then the sales and use exemption on alcoholic beverage tastings. This one's a little more complicated, and it's not really my area of expertise. But if you've got a farm winery or a farm brewery or something, there's some exemptions on the supplies that you use for the tastings, and you don't have to charge sales tax. Usually, that alcohol is taxable, but you don't have to charge tax on the tastings that you provide to people. But look into that more closely, because that's definitely outside of my bailiwick. So that's sales tax, and there's a ton more of those things. It's just those are the ones that I thought are the most applicable. So a flower farmer would pay sales tax on the flowers they sell to a florist market store. So flowers are taxable, right? Like, so if you sell flowers to somebody, to a customer, they are taxable. But yes, if you sell flowers to a florist and then they're going to sell them, if that florist gives you the form that they're tax exempt for resale, then you wouldn't charge them sales tax. So, but they would have to, it would be incumbent at that point on the florist to give you the form. It's not, that's really not your problem, that's their problem. Vegetables are not taxable. So that's sort of, that one doesn't really matter. Like if the vegetables are turned into something, then they could be taxable. So yeah, you would always charge sales tax unless somebody provides you that. I'm more thinking if you're buying something that you're going to resell, that you don't have to pay sales tax on that. That's really, ultimately, that's really the bigger benefit for you, so that you're not paying sales tax on something, you know, to somebody, and then you're selling it, and then the customer pays you sales tax, but you don't get that. You send that off to the state. So it's a way of saving yourself some money for something. The state ultimately will get their money, I guess is what they're saying. Ag assessment, this is probably, if you work in extension, this is what you get like 99% of your calls are, how do I get ag assessment? This is also a big benefit to farms in New York or farmland owners. So farm that's in commercial ag production, if it's more than, I think it's 7 acres, and generates more than $10,000 in sales, you can get the assessment goes down to the agricultural value of that land, and that will vary depending on the quality of the land and the tax, you know, and the tax level of that place. So what's really interesting with ag assessment, I think what confuses the most people is that, you know, you can have 2 towns that are right next to each other and they have very different tax rates. And so one person's ag assessment will be worth a lot more than another person's ag assessment. You can also have 2 people in the same town, but they have very different soils, like the property is very different. And so they will have very different ag assessments too. So it's all based on the soil type and the tax rate, you know, of that community. But it's still, it can be quite a good benefit for people, but it definitely goes to the landowner, not the farmer if you're a renter. But the owner can get it based on the farming activity of the people that they rent to. The farm building tax, 10-year tax exemption if you build structures for agricultural production use, that you can get exempted from property tax, the property tax increase for 10 years. The key thing with this one, and this is you go to your assessor, you have to apply for it within the first year that you put that structure up. You can't go back 3 years later and say, oh, I built this building 3 years ago. Can I now get the exemption for this? It has to be, you have to apply within the first year. So I've seen people who've missed this opportunity because they weren't aware of that program. Similarly, you can get a permanent exemption from a registered farm labor camp on your property, or a temporary greenhouse. So that's one that's covered with plastic and it's not a permanent glass greenhouse. A permanent greenhouse is eligible for the 10-year tax exemption, but a temporary greenhouse is eligible for a permanent exemption. And these are all ones that, once again, you would go to your local assessor for. 2 other programs that are related to property taxes and that I know a lot of farms use, the 480A forest tax law. If you've got more than 50 acre parcel that's in forest and it's managed for forest production, you can also get a property tax reduction on that. And then what happens is when you harvest the timber, you pay a tax at that point. So it makes the annual cost of carrying that land lower. But you do have to have a forest plan, and it has to be actively managed, timberland. The other program that is, becoming increasingly valuable for farms is the solar, wind, and energy system, 15-year tax exemption. This is one where it's up to the local community whether they want to participate. So you could live in a place where the community says, no, we don't give that tax credit. But where they do give it, you can get a reduction on your property taxes for up to 15 years for putting in a solar, wind, or other, like a bio energy system or other type of energy system. So this is something, once again, if you're working with a solar developer, they'll probably help you with that. But if you're developing something on your own property, it's something that you should be aware of. So now New York State income tax return. These are all tax credits from a wide variety of different agencies, but the place where you apply for them generally is when you file your annual state income taxes. And there will be a form where you'll fill in all the information and the credit will come to you, as part of your income tax refund. It doesn't mean that it's a tax program. It's just that the place where you apply for it is on your income tax return. So these are ones, and that I'm aware of. There's the farm donation to food pantries credit. That's a refundable tax credit. And this one, could be quite useful for some farms. It's 25% of the fair market value of qualified donations made to any eligible food pantry operating in New York during the tax year, up to $5,000. I work with some veg farms. Let's just say you've had a really good crop. You don't want it to go to waste. You maybe have more than you can sell to your markets. You don't want it to go to waste. If you donate it to this produce, or whatever, to an eligible food pantry, and it does not have to be first quality product, the food pantry has to take it. But if it's, it can be stuff that they might use in other types of food prep or whatever, you can get, you can get a tax credit for that, and it's a refundable credit. So, that is money that you would have coming back to you. So that can be a really good thing. The farmer's school tax credit is a refundable tax credit that equals 100% of the school tax is paid on qualified ag property where the acreage doesn't exceed the base amount, 350 acres. I think it's reduced after that point. But that's also one. Yes, you do need documentation for the food pantry credit, but it would come from the food pantry that you provide the food to. Kind of like a charitable donation. And there's a ton of all of these things have all the rules on the links I've provided. But this is one where you have to be a significant commercial farm. I think I want to say a third of your income, but somebody can correct me if I'm wrong, has to come from agricultural production. And then there's also an income limit. So if you're a billionaire, even if for some reason you're a farming billionaire, you would not be eligible for the farmer school tax credit. So there is also an income threshold for that. Conservation easement tax credit is a refundable tax credit based on the value of a conservation easement, and that will vary based on the easement and the value of the property. The investment tax credit, this is also, these two in brown are not specific to farms, but they're relevant to farms. This is the investment tax credit. A lot of people, you put in infrastructure, right? Like you buy a tractor, you build a building, you make a significant financial investment in your business. You put in a new cooler, you put in a irrigation system. There's a tax credit for that. And it's refundable for new businesses. So that's something that'll show you. There's a form on your tax return. Similarly, there's a barn rehabilitation credit that's refundable for new businesses. And that one is 25% of the expenditures that you have in restoring this historic barn. The investment tax credit depends on the type of investment and the amount of the investment. There's also, related to those two, there's an employment incentive credit. And so if you do either the investment tax credit or the historic barn rehabilitation credit, if you also expand your workforce, and it's not even by that much, I think it's just you go from 100% to 101%. If you expand your workforce, you also get a credit for expanding your workforce. So, and that all shows up on the same form. New York also has a farm workforce retention credit. The amount went up every single year. Right now it's $600 per worker. And the governor it was supposed to end this year after this tax year, but the governor just announced that they plan to extend this credit to 2025 and increase the amount. So this fund for farm employers is huge. You should definitely be aware of this. These are other state tax credits. There's an alcohol beverage production credit. I know I work with a lot of farm wineries and farm breweries and stuff. So that's a refundable credit based on the amount of alcoholic beverages you're making. There's other state tax credits for labor. And these, I think, because labor is just so expensive, you know, any credit you can qualify for labor, you should definitely be looking at. In New York, if you've hired a veteran, unfortunately, they have to have been employed before January 1st of this year. There's a tax credit for that. If you hire an apprentice through a New York State registered apprenticeship program, there's a tax credit for that. If you hire an at-risk youth, there's a tax credit for that. If you hire a disabled person, there's a tax credit for that. And these are all ones that are, you know, programs through the Department of Labor, but that you would receive the funds on your income tax return. And so really looking at your workforce, you know, if you, you know, at the state of, you know, if you are able to look at hiring sort of a diverse workforce, or maybe you have people that you might have workers, you know, especially like at-risk youth or veterans, you may have people already working for you that actually qualify for these credits. And so just being aware of who your workforce is and whether or not they qualify you for tax credits, I think could be increasingly important. Excelsior Jobs Program, actually, and I'll go back to the tax credit for labor. When these sort of tax credits for labor came out, a lot of times what employers do is they, you know, especially if these things are mean tested or whatever, they'll like go through and look at your workers and say like, you know, if I've got workers earning a certain amount or they're between certain ages, or, you know, should I, you know, going in and figuring out whether they're eligible for certain, you know, they're eligible for this can save you a lot of money. So it's really, this is something that I think farm employers especially should look at. New York also has what they call the Excelsior Jobs Program, and that's through Empire State Development. This is also refundable tax credits. And these are generally based on, once again, like based on infrastructure projects, especially if you're going to expand your business. So for ag, you have to hire 5 new positions in order to get the jobs tax credit. But then you can get a credit, you know, based on the wages for these new hires. There's an Excelsior investment tax credit. So if you are putting in, once again, if you're making a significant capital investment to your farm, and you're planning on that, you're going to put in a processing facility, you're going to put in a farm winery, you're going to spend some serious dollars to like upgrade or to grow your business, you should be looking at these investment tax credits. These are really important. Another one that's kind of cool is there's an employee skills training incentive program through Empire Development. This is also a refundable tax credit. And so if you're making an investment, and then you're going to need employees who, you know, like let's just say I work, you know, like you're a farm, you're a dairy farm, and you're going to go to robotic milking or something. And, you know, you'd like, you know, you've got to train your workers to use this equipment, but you'd also like to give your workers some other skills that will help them, you know, sort of be stronger employees. If you're making a significant investment, you can also apply for a grant alongside of that to cover the cost of training for your employees, to bring a trainer in for training materials, to send your employees off to a class or something. And it's just that the value of the training, there has to be a 10-to-1 ratio between that capital investment you're making and the training cost. So if you're putting in a, you know, a $10,000 you know, piece of equipment and you're making that capital investment, then that would give you the ability to access $1,000 towards training of employees through this program. So that's something also to consider, like if you want to be able to bring trainers in or people to work on developing your employees. So that's what you would see on your state return. And then on your federal return, there aren't as many tax credits. The federal return is much more sort of the stuff Bonnie covered, where it's, you know, sort of tax advantaged planning. She covered the fuel and excise tax credit, and that's a refundable tax credit. But there are also, just similar to the state, there's a bunch of tax credits through DOL on the work opportunity tax credit. And that's where, you get a tax credit on the wages you hire to people that are otherwise, either long-term unemployed or recently released from prison or are developmentally disabled or are, part of a job training program. You can get a tax credit for hiring people like this. When I worked in Louisiana, that actually, we had, kind of like we have in New York, there were a lot of programs that really, sort of the prison release programs. A lot of the farms used those programs down there. And I talked to farmers that really, really liked them. They said that their worker, that often the employees were working, they had somebody from either a program or the parole officer, somebody sort of like overseeing them and making sure that they were doing okay. But they were also very motivated. They said, these are guys that are like looking to get back on their feet, and we're actually good employees, and there was this tax credit for it. So that's something as as the workforce is really tight. These may be places to both look for employees, but also to receive some federal and state assistance for this. One concern people may have is that being unsure about, especially, the prison, but also other jobs. There is also a federal bonding program. So you can receive bonds free of charge when you hire certain applicants. And that would reduce, those bonds would reduce the employer for any loss due to employee theft. And they cover the first 6 months of employer at absolutely no cost to the applicant or the employer. So that's, also something that's available just sort of to give you a little extra layer of assurance. There's an employee retention tax credit for COVID, and this is specifically a COVID program. This program has changed multiple times, so it's very complex, but it's basically, in a nutshell, for a business that suffered. Currently, it would be an 80% loss in income compared to 2019, and that's quarter by quarter. If you've had that kind of a loss in revenue and you've maintained your employee base, you can get a tax credit based on the full costs of that employee, not just their wages, but also all of their fringe benefits. So that's something to look at if your business is really, seeing some downturn due to COVID or around that time, maybe, compared to 2019. And then finally, there's also a credit for paid sick and family leave due to COVID. Or COVID vaccination. So if you have employees and you've had to pay for sick pay for them, even this year because they're out due to COVID, you can get a refundable tax credit for that also. So that's something to be aware of. And I think that's it. I know I ran through them quick, but I do have, as I said, a sheet that you'll get where there's links to all of these programs. If you're still awake.
Well, I think that was what a perfect overview. If anybody has any questions about the specifics of any of those programs that Liz or Bonnie mentioned, or if you're wondering if something might apply to your business, please feel free to write it in the chat, or if you raise your hand, we can unmute you too.
Hi, I have a question. Can you hear me?
Yep, you're good, Beth. Thank you.
So there were two mentions of the fuel tax credit. One earlier on, which you guys sent out a link for, and then one later on that was a different form. Can you explain the difference between those quickly? Unless I misread something there.
So there's a state fuel tax credit and a federal fuel tax credit. So,
Gotcha. Okay.
So that's one. So you can both get a tax credit at the state level. And that was the one where I showed, like I talked about all of the forms. And that's New York State. And then there's a federal tax credit, and it's based on the excise tax for fuel used in farming also, and Bonnie touched on that. And that's a federal credit. And that would be on your federal tax return. The tax, I'm going to ask Bonnie that one, because Bonnie's been a tax preparer for years.
I think that Bonnie,
Oh, is she gone?
yeah, she's been popping in and out. Let me just check, see if I see her, but I don't think she's in right now.
I'll be honest, I don't do farm taxes, so I don't want to answer what, I mean, I'm imagining that they can.
So the federal tax, I can jump in here if it'll help
Yeah.
you. This is Joan Petson. And so the federal excise tax is based on so much per gallon. And so it is, as long as you have bought the fuel and you have not applied for an exemption, you can get that tax on off-road fuel. It has to be all off-road fuel. And so as long as you know how many gallons of fuel you used off-road, then you plug the gallons into that form 4136, and that's how you figure the credit on that. I'm not as familiar with the New York forms, but I'm pretty sure that those you basically need to provide copies of receipts to go along with those.
Any other questions? So, yeah, when you get home and you look at this sheet, like if you have more questions about any specific program, definitely feel free to, either contact Caitlin and she'll feed it out to us, or you can contact me. My contact information will be on the sheet you get. Because some of these, it's hard to give a lot of like excruciating detail about all of different scenarios, because some programs are really complex. And so, what one person might be eligible for, somebody else might not, or, and it's hard to say like how much you would get or whatever. So if you're confused when you look at it, definitely let us know. And 8 o'clock at night is not our peak time for mental math calculations. So
There is another question asking, where can we find a good ag tax preparer?
That's always hard for us to answer, because, we don't have people. I'm not a farmer, so I don't have anybody do my taxes. So I think it's really finding a good one is talking to other farmers and getting recommendations from them. As Philip just said, because that's going to be, somebody who's really satisfied with their tax preparer is, and if you talk to 5 or 6 different farms and they're all using the same person and they're all happy, that's probably a good tax preparer. So that would really be my best advice. Finding people who have businesses similar to yours. Also, somebody who does dairy taxes or like a commodity program type farm might not be as good for your business if you're mostly like agritourism and you've got a restaurant. And you've got other stuff going on that's like sort of in that gray area between ag and non-ag, because some of the tax incentives or tax stuff that you'll do may be quite different.
And Joan added another point too, is to talk to your lender. They might have some good references based on their clients and who they're working with.
Unless they also do taxes.
Then you just walk
So.
across the hall, right?
Yeah. Yeah. No, I think, no, lenders are a good suggestion. I would say lender, because they often will see the results of somebody's taxes or non-tax stuff.
Great. So if anybody has any other questions, feel free to drop them in the chat or unmute. We won't hold everybody on here tonight either. So
I might add,
ahead, John.
Caitlin, if you're looking for a tax preparer, it is fair game to ask them how many farm tax returns they've prepared. Can you give me the name of 2 or 3 clients who have businesses similar to mine that you have prepared taxes for? I think those are some good questions if you're talking to a preparer to get comfortable with whether or not they are the right one for you.
Yeah, another place might be to your, like a growers association or like a group like that. My brother's a musician, like a Broadway musician, and he's got a very specific set of taxes. And so he got his tax preparer through his union, like that was where he got recommendations because they were all musicians.
All right.
So, all right.
I think we'll hang on for a little bit if anybody has any questions that they'd like to ask pertaining to their specific situation. I'm going to include the feedback survey here in the chat right now. If you want to click on that and have it opened before you head out of the meeting. And then, as we mentioned, everybody will be receiving the recording as well as the kind of fact sheet, reference sheets that both Liz and Bonnie put together, that if you are wanting to go learn some more information about any of the topics that they've talked about, you can get to those links from there. So with that, thank you, Liz and Bonnie, for presenting. Thank you, Joan and Nicole, for helping to jump in. And if anybody has any questions from here, please don't hesitate to reach out to any of us or send me an email and I can help to triage it from there. And hope everybody has a great night. Like I said, we'll stay on, but please feel free to go ahead and leave the meeting if you are all set for now. Thanks, everybody.
Yep. Good night.